Come on. Two,
Good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, June 1st, 2022. And our top story today, how inflation may impact commercial real estate returns in 2022. Today's episode is powered by the Defined Contribution Real Estate Council. To learn more about DCREC and its members, visit www.dcrec.org. And joining me now to discuss this and a lot more, Tim Wang is Head of Investment Research for Clarion Partners. Tim, it's great to see you. Thanks so much for joining us on the program this morning.
Hi, Jeff. Thank you for having me.
Well, I'm excited to see you and talk to you. And, real estate's a really important topic these days. But I want to start off with a baseline question. And you can't help if you're an institutional or an individual or retail investor, all you hear about is inflation. And I guess my first question to you is, what's the outlook for inflation, and how does that inflation impact real estate?
Yeah, well, Jeff, that's the question of the day, right? If you look at what causing this inflation, it's really the mismatch between the robust demand recovery and also the supply chain disruption at the same time. So if you look at the U.S. total retail sales rebounded by 62% from the pandemic low. So that's a strong recovery, caught many retailer and supplier and distributor by surprise. If we look forward, right, as the Federal Reserve continue to raise interest rate and continue to tighten quantitative tightening, and this policy action, in our opinion, should reduce some pressure on the demand side. You look at the April new home sales already declined by 16.6% over March. So that's just one example of that. On the other hand, the global supply chain disruption already shows some sign of easing. So we hope they will continue to improve over the next 12 to 18 months. If you combine this demand and supply situation, we believe that should result in a moderating inflation over the next year or two. So for commercial real estate as an asset class, overall demand so far has been strong. And although we're seeing that rising interest rates are making financing a little bit more expensive. And last year, U.S. commercial real estate returned by 17.7%. We think this year probably going to moderate from that level, but going to remain solid because the landlord has the ability to increase rent and the increase in property cash flow.
Tim, people say that, if you're a portfolio allocator, real estate is a great hedge against inflation. And I guess my next question is that still the case given all the circumstances you outlined with supply chain disruption, global geopolitical events in Europe and elsewhere? Is it still a good hedge?
It is. We believe that. And if you look in history, commercial real estate has been well documented to be able to hedge against inflation for two main reasons. One, as I mentioned earlier, landlord generally has the ability to increase rent under better economic conditions. So as a result, property income should be higher. Second is actually replacement cost, which is very unique for commercial real estate because land price, construction material price have risen a lot, especially during a period of high inflation like today. So it will be more expensive to develop a new building. So this in turn will leave more room for the existing assets to grow value. So that's the two reasons for commercial real estate's ability to hedge against inflation. Although, as you mentioned, the pandemic is rather unique, and real estate can only be an effective hedge if the landlord has the pricing power to increase rent. So this pandemic has impacted different property sector differently, right? And as you can imagine, some property sector, such as industrial warehouse, right, multifamily, life science real estate have benefited, right, just significantly from this shift during the pandemic. While other sectors, such as CBD office, regional mall, high street retail, can only start to improve as time continues. So again, if you invest in a well-diversified real estate portfolio, well-designed portfolio, we do believe that that investment should be able to hedge against inflation.
Yeah, and let me ask you about the return to work, and you kind of referenced this in some of your comments, but I just want to go a little bit deeper. People are returning to work, and depending on where they live and the industry that they're in, what's the impact of this return to work to commercial real estate, for example, in the technology or data center or commercial buildings? Is that having an impact to where real estate, commercial real estate is today and where it could be in the near term?
Yeah, Jeff, that's a good question. We believe that technology is disrupting every industry, and real estate is no exception. So we have seen that for the first hand that e-commerce, right, has been hurting retail real estate, helping warehouse. I think this pandemic proved in a different way that Zoom technology, working remotely, and has proved to be very effective. So this return to work, online shopping, everything else, definitely disrupt commercial real estate as an industry. So again, certain sector benefited from this shift. We talk about warehouse, we talk about housing in general, but some sector, property sector actually suffer as a result. In particular, when we talk about shopping mall and also CBD office, that remains to be seen is a big question mark.
Tim, I guess kind of transitioning, and our show is about retirement and accessing asset classes like real estate. And so today, institutional investors in pensions, endowments, and foundations all have access to real estate, right? They can get it in their portfolio today. If I'm an individual investor and I'm in a 401k or a 403b or a 457 plan, how can I get access to real estate so that I can diversify my portfolio?
Jeff, that's a great question. As you mentioned, right, institutional investors such as a pension fund, sovereign wealth fund, and insurance company, they have been investing in commercial real estate for over the past 40 years. Their average target allocation to real estate has risen steadily now to over 11% as of this year. They typically invest through professional real estate manager, or they buy assets directly in their portfolio because they're a large investor with a lot of capital deployed. Now, we're seeing that individual investors also recognize that their investment portfolio, either in the 401k or other retirement account, should not just be the traditional 60% stock or 40% bond. And they want to add real assets, including real estate, into the mixed asset portfolio for the purpose of diversification, current dividend, and very important, hedge against inflation. So there are a few ways individual investors can access real estate. One of the quick ways is obviously you can invest in public traded REIT stock. Although this stock sometimes can be volatile along with the broader equity market. And the second way is you can buy individual real estate assets, such as a multifamily apartment. You can become a landlord yourself. But I have to say that property management work sometimes can be challenging and time-consuming for non-professionals. So more recently, we're seeing that many retirement and defined contribution plans are adding professionally managed real estate funds, either in the target date fund format or in a separate election choices. We believe that gaining exposure to this kind of real estate investment should help against inflation and enhance portfolio diversification, and also improve the risk-adjusted return over the long term.
And there really, as you said, I mean, there has been an evolution of the products. It used to be things like liquidity or the lack of liquidity were real challenges. Fast forward 5-10 years, that's no longer an issue for defined contribution plans, which trade daily, intraday.
Yeah, absolutely. I think that the product continues to evolve. The liquidity, although still they're not as liquid as bond or stock, I think that many real estate products are being designed as much more liquid. You can trade on a more frequent basis. So it is a revolution. It solves one of the key concerns among investors.
Yeah, it's certainly fun to watch, and the real estate industry, the asset management industry and the retirement industry continues to evolve to solve a lot of these challenges to get America saving. Tim, thank you so much for joining us, and we look forward to having you back on the program again very soon.
Thank you, Jeff.
Well, thanks, Tim. And when we come back, how public and private real estate can fit into a retirement plan portfolio and investment lineup. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back, and a reminder, today's show is powered by the Defined Contribution Real Estate Council. To learn more about DCREC and its members, visit www.dcrec.org. And joining me now to discuss public and private real estate, John Worth is with NAREIT and Nick Colley is with CBRE Investment Management. John, Nick, great to see you. Thanks so much for joining us on the program this morning.
Thanks for having me, Jeff.
It's great to see you. Nick, I want to start with you. We had a great conversation with your colleague, Tim Wang of Clarion Partners. He's not, technically, he's a DCREC colleague. We'll just put it that way. But he's a real estate professional, gave us the outlook on inflation, the markets, and obviously things are a little bit choppy now. But I want to get your particular outlook when it comes to both private and public real estate.
Yeah, sure. And thanks for having me on. It's a real pleasure to be here, discussing what we think is the opportunity really to be investing in real estate, both over the long and short term, and as you say, particularly given the volatility that investors are experiencing in their wider portfolios. I think probably the best way to start answering the question in terms of outlook is probably just to take a step back and consider some of those sort of key characteristics of the asset class, both public and private, and the role that real estate can play in helping investors sort of meet their objectives. So when investing in core or public real estate, investors generally trying to gain exposure to high quality cash flows. What do we mean by that? So it's really gaining exposure to modern, fit-for-purpose assets that are located in major metropolitan areas where occupier demand is typically sort of more robust. And what they're trying to achieve here is a consistency of high occupancy and high rental cash flow payments that are of course contracted. Now these contractual cash flows can help protect investors really in terms of against inflationary pressures. So through increasing rents, through rent reviews or new leases, you're really able to drive those rents forward to try and protect yourself against inflationary pressures. You're also looking for high quality, core portfolios that have stable, strong balance sheets, modest low leverage, the debt and the debt characteristics that they have aligned with both interest rate cycle and the asset management plan. And generally speaking, accessing this asset class, you're looking to create stable, generally higher income returns than compared to other asset classes, in the expectation to receive strong diversification potential. So now just coming to really sort of picking up on the sort of outlook for both the private and the public sort of real estate sort of asset classes. Now, given the volatility we're experiencing and that changing environment that you mentioned in terms of moving to a higher inflationary environment, historically we've actually seen both listed and private real estate actually outperform wider equities and bonds during periods such as this with higher inflation, and particularly higher inflation with moderating growth outlook. So how should investors be thinking about positioning their real estate portfolio to best capture these very attractive sort of cash flow and risk characteristics? Well, starting with sectors, we invest here at BRN AM. Our portfolio is based on high conviction calls in terms of capturing long-term structural occupier trends. And by that, we mean maintaining a structural and tactical overweight position to growth sectors, as we call them, such as logistics, residential, but also less traditional real estate sectors such as self-storage and life sciences. And we think that makes a lot of sense from a risk-adjusted perspective, just because the occupier fundamentals still remain very robust and generally have a undersupply of that high quality assets and occupier space that obviously businesses are seeking in today's environment. And what we're seeing in these sectors is, we've come from a period of very strong, income and capital growth, and we're also now expecting, income growth to remain strong and robust given those, general undersupply of that high quality space. And we think that positions a portfolio to actually best pass through those inflationary pressures onto the occupier through those contracted rental payments. And in addition, some sectors such as residential and self-storage have that sort of shorter lease length than say typical for logistics or offices or retail, where actually that mark-to-market of rents happens on a more frequent basis, and that can also help investors in terms of protecting and capturing that income growth and passing through that inflationary pressure. Now these themes are probably not new to the viewers, and they're pretty consistent to us in terms of both the public and the private space. But I think it's probably important here to state that actually, investing in these sectors, we're not investing in them regardless of price or by compromising on asset quality, which is obviously the key to driving that sort of long-term outperformance, in terms of delivering that disciplined investment process that our sort of clients require us to make sure that we're buying assets that are, pricing the risk adequately. And turning to perhaps the public space now in terms of thinking about what's going on in that sort of wider mark-to-market in real-time sector that real estate, or you can access real estate in. Year to date, we've seen very similar price correction in terms of with the wider equities market, so down around 17 to 18%. However, we think that this is actually a slight mismatch in terms of what we're thinking in terms of the relative strength of earnings growth going forward for the wider equities market and say the real estate portion of the equities market, where given the strong occupier market fundamentals, in our preferred sectors, our team of analysts are still seeing some interesting opportunities to actually access very high quality operators with high quality portfolios, a pretty attractive pricing, with some REITs now trading at around sort of 20% discount to estimated net asset value. So essentially our sort of outlook is, and our message is really, the uncertainty that we're experiencing at the moment, it's really bringing some opportunities now for some active managers like us in both the private and public space to really think about and source some attractive opportunities in our preferred sectors, and utilizing our investor operator, wide network that we have within the market to actually benefit and continue to benefit from these structural growth stories playing out in the occupier market.
Thanks, Nick. And John, I want to come to you because I want to bring in you in the NAREIT story. And you've had a very interesting career. Started your career, you were at the U.S. Treasury. Now you're at NAREIT. What's yours and NAREIT's perspective on private and public real estate?
Well, I think a lot of the themes that Nick hit on are really, really important to us and sort of worth almost re-emphasizing. I think, first off, one of the things we certainly find when we look at REIT performance is that because REITs are fundamentally real estate assets, they share with private real estate that good inflation protection, which is one of the reasons it's so important for commercial real estate to really be part of every portfolio in a meaningful way. So just for example, in the US, we look at REIT performance, what we find is that during periods of high inflation over 7%, which is what we're experiencing now, REITs are going to outperform the broader stock market historically by about 3.5%. And what we see is that that's not just an artifact of the stock market or stock market pricing. That's really driven by their growth in net operating income. Their property operating income is growing faster when inflation is higher. And that's that ability to pass through rent increases. And as well as you get, in addition to that, you get the benefit of the value of the asset is increasing during a period of inflation. So I think that's one of those critical components. And this period is a great example of, I think, why over the long term you want to have a meaningful part of your portfolio in commercial real estate, both for diversification benefits in almost every market, but right now you're seeing the benefits of in terms of inflation protection. The other piece Nick hit on that I think is really important to emphasize is this growth and change in what we know to be commercial real estate. Sort of the economy has obviously changed dramatically in the last 20 years. We've become more digitized. That was sort of put on hyperspeed through COVID, and really importantly, commercial real estate has changed at the same time. Today, more than 35% of the market cap of the U.S. REIT index is actually related directly to the digital economy, either being in industrial and logistics, data centers, or cell towers. And then you add to that other forms of the changing economy: healthcare, self-storage, increased use of multifamily. All of those are areas where REITs are providing real direct access, and in some of these ways have really been on the front edge of that innovation. And that's why I think it's so important for portfolios both to have commercial real estate, but also to be using REITs to get access to some of these innovative property sectors.
Thanks, John. And Nick, I want to come back to you. I think you both and your colleague Tim from DCREC also really made a strong case for real estate. I guess my question for you, Nick, is how can investors and you're part of the Defined Contribution Real Estate Council. So defined contribution, 401k, 403b, 457, those are typical defined contribution types. How can investors access these asset classes or sub-asset classes, in the case of public and private, in their retirement plans?
Yeah, no, absolutely. I think what's important to note here as well is, we don't see, the private and public as being an either-or decision. I mean, as John mentioned, there are some hugely complementary features of both ways to effectively get to the same cash flows underlying the investments. There's no one-size-fits-all type portfolio, but we certainly think that sort of DC retirement plans can really capture some, very strong risk-adjusted returns through implementing a complete solution, as it were, in terms of both private and public. In terms of the private space, we've got open-ended core diversified funds or sector-specific funds, and some of these have now they've been well established in terms of providing access to private real estate for defined benefit institutional investors. But now we're starting to see an increasing number of these funds providing daily pricing, so that DC capital will make it more efficient and more practical for DC capital to actually access this private real estate space. And that's as I say, that's really important in terms of just trying to now pick on the complementary features. So private typically has a slightly higher income component than say the listed space, whereas the listed does provide that additional growth really that comes through. So depending on how a DC plan or an investor wants to position a portfolio either more defensively or position it for more growth, and they can start playing with those tactical allocations in terms of between the public and the private space. And of course we're seeing at the moment the volatility in the public space creating some pricing opportunities there compared to say the private market, where the listed market may be slightly more influenced by the wider equity market sentiment in the short term, but as John said, in the longer term, these are both very good ways of gaining exposure to the real estate asset class, and it delivers the same sort of risk-adjusted returns.
Well, thanks, Nick. And John, I want to bring you back into the conversation to kind of round out this public-private inclusion in defined contribution plans. As Nick said, there has been a lot of evolution in the asset management industry, specifically around including these types of asset classes in plans. And so it makes the case for fiduciaries, people around the table looking at these plans, to think about ways to include these asset classes in these DC plans. So is it target date structures? Is it managed accounts? Is it a direct fund on the investment menu? How do you see, and NAREIT see, the evolution of DC plans to include some of these asset classes that, quite frankly, are in pension plans, endowments, foundations, where other investors have access?
Yeah, and Jeff, I think the answer is, in a way, all of the above. One of the things that we really see is the DB sector and the DC sector in some ways learning from each other. Obviously, the DB sector has had dedicated allocations to real estate for many, many years. The DC sector is increasingly moving in that direction. What we see is that today, virtually every target date fund has real estate allocation through REITs, and about 60% of them have dedicated sleeves. That's really important. But the level of assets being dedicated to commercial real estate, it's well below what you see in the standard or the average traditional DB pension plan, which is around 10%. We're seeing more like 4 to 5% in target date funds. So I think there's learning going on in terms of DC plans need to bring up that allocation to commercial real estate to really get more of the benefits of commercial real estate into their portfolios. What we're actually seeing is with DB plans, they're in some ways learning from commercial real estate, from the DC side, in terms of using more listed real estate, reaching out and using REITs to get access to some of these new economy property types. So we're seeing, I think, some very useful cross fertilization. But like I was saying, in terms of the vehicles, it's really all of the above. What we have historically seen, though, is if you just put a REIT or real estate option into a DC plan, you'll get very little uptake. It's really critically important for it to be in the target date fund, because I think the average investor, the average plan participant, they just don't have the confidence to create their own asset allocation. And so it's so important for asset allocation vehicles to really be thinking through that comprehensive solution. Like I said, what we've seen over the last years is more and more plans using real estate and allocations going up, but we think we're still a long way from being near what the models would tell you is an optimal allocation to real estate.
Well, I would agree with you, gentlemen, in terms of education. I think we've started that conversation today. You and the folks in DC REC have continued that conversation with fiduciaries and consultants. I think it's just going to take more time and recognition, but these are certainly interesting times as we're seeing, and it may behoove fiduciaries to take a look at multiple options. Gentlemen, we're going to have to leave it there. Great to see you both. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Cheers. Thank you.
Thanks, John. Thanks, Nick. Great to see you. Thanks for sharing your perspective. That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to? Drop us a line, and don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? Well, visit our website. That's www.broadcastretirementnetwork.com, and our streaming partners. We're back again tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.